Welcome, everyone. We're so glad you can join us for this webinar hosted by JFL Total Wealth Management to review the fundamentals of investing. The financial industry is filled with some heavy jargon and some complicated products that can leave the common investor overwhelmed. And in these volatile times, your confusion can be further exacerbated by the daily changes in the stock market or the economy. Sometimes it's helpful to step back and revisit the basics. Think about the whys, the whats, and the hows of investing, as well as what you can hope to accomplish with short and long-term investment horizons. Today, we want to talk about the fundamentals of investing and hopefully teach you, or maybe just remind you about the foundations and philosophies JFL uses every day when managing your money. We encourage you to send in questions through the questions feature on the webinar panel, and we'll answer as many as possible. If we run out of time and your specific question is not read during the webinar, we'll follow up with you directly to provide an answer. And as always, a recording of this video will be posted on the JFL website at jfltotalwealth.net/webinars in the next few days. So without further ado, let's introduce our two panelists for today. We have Jeanne Kane, who has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 23 years, working in the financial industry for more than 30.
Hello, everybody. Great to see you today, virtually.
All right. So before we get started with the formal portion of our presentation, we just wanted to do a quick poll of today's attendees just to understand how knowledgeable an investor you consider yourself. Please take a moment, if you would, just to answer this question. And it can basically be, I'm so glad someone else is handling this, to I know the basics, to I understand more complex. There, what our results are. So it shows that it looks like we've got about 2/3 of our attendees know the basics. So, but hopefully today we'll be able to help out some of those people who maybe need a little extra help as well. All right. So Jerry, maybe you can tell us a little bit about what our agenda is going to be for today.
All right, so I want to talk about a couple things. First of all, thank you very much for taking time out of your day to listen to us. I think this presentation is going to be videotaped, and I think it would be helpful for many of you who have children who you want to start getting on the path for investing. A lot of times when I talk about investing, I bring up a buddy of mine, Bobby Jones, who probably in second grade I used to play soccer with. And Bobby used to know how to do the banana kick, the scissor kick, the bicycle kick. He had about 15 different kicks that he could do. And he was terrible in soccer for one specific reason, is 90% of soccer was the basics, passing it to the person who was open at that moment in time. He was so focused on the complexities of soccer that he never really focused on the basics. So really what I want to do today is talk a little bit about the fundamentals of investing, just to talk about the basics, because I think if you got the basics down, you're going to do a very good job. Understanding that volatility is part of the normal investment cycle, and it's actually something that we could use to our advantage, especially over a long period of time. Some of the strategies that you may want to consider during these types of volatile times as you know, we're going through this, and understanding some of the differences between what's happening out there with the economy and what's actually happening with the stock market. At the end, we'll have an opportunity to do question and answers, and I would just say write the things down, put it in the, I think, the right-hand side. You can put in any questions you have, and we're happy to answer them either here, or if it's taking too long, what we'll do is we'll get back to you on the side. But again, thanks again for the opportunity to speak. And if you have any questions, please get back to us. So Jeanne, why don't you talk to us about what is investing and how we can make everybody's life a little better through it?
Happy to do that. So at its most fundamental level, when you invest, you give your money to a company, government, or some other entity with the hope that they provide you with your money and then some back in the future. Investing is different than saving, trading, or simply holding on to your money. Investing is for the long term. Let's go ahead and take a look at an example. Let's look and see what happens to $20,000 over the course of 30 years with some different options. If you put your money under the mattress, for safekeeping, in theory, you'd be no better or worse off in 30 years because you'd still have that $20,000. However, I'd say in 30 years, you're worse off than where you started because of inflation. Now, if you save it and you put that money in the bank, say a savings account or a money market account, you may be able to get some guaranteed rate of return. You're looking here at about 2%. Your money has grown by 80% in 30 years. You're up a little over 36,000. Not too bad. But finally, if you invest it, and say it earns about 5.5% annually, your money would have grown by almost 5 times in 30 years. That's pretty significant. Now, there are no guarantees with investing. The markets are going to go up, the markets are going to go down. And you can also lose money. But over an extended period of time, you'll generally come out ahead. Now, I mentioned inflation on the previous slide. Let's take a look at an example of how that can impact you financially. About 100 years ago, you could buy a quart of milk for 14 cents. 50 years later, you can buy only 2 cups of milk for that same 14 cents. And just a couple years ago, that 14 cents, that would only buy you 12 tablespoons, or about 3/4 a cup of milk. Your money today will likely buy less tomorrow. Said another way, it will cost you more in the future to buy the same exact product. That quart of milk today, that's about $2.19. It's important to understand how inflation impacts your saving and investing as well. The current inflation rate is 2%. Now, your savings and your investments need to earn at least that amount to have the same buying power in the future. Now, Jerry's going to talk a little bit about some very specific types of products. Jerry?
I live for it, Jeanne. All right, so when we're talking about general investing, I'm really talking about 2 different things here. I'm talking about stocks, which is ownership in companies, and bonds, which are glorified IOUs. I'm not getting into business ownership or real estate at this time because I think getting to my Bobby Jones conversation, I don't want to make this more complicated than it needs to be. So when we have bonds, bonds are basically glorified IOUs, and they could come from a variety of different sources. They could come from the federal government. The nice thing about lending money to the federal government is that they can hit a printing press and they could print you back your money and give it back to you. So you know you're always going to get paid. And they're going to give you the lowest rate simply because of the guarantee that you're going to get your principal back. Now, if I borrow or I lend money to Pepsi Cola, am I going to get my money back? Well, it's very reasonable I'm going to get my money back, but they can't pay me in Pepsi dollars. So they're going to have to charge a little bit more than what the federal government does. And then there's junk bonds. Basically, those are higher risk bonds. And what's going to happen there is that they have to pay the highest premium because the chance they may not default. So the risk that you're seeing is, again, first of all, is inflation going to be greater than the rate of return that they're giving you, the interest that they're giving you on your money? How long do you have to hold your money with them to get that interest? How stable is the income payments that you're going to be getting? Do you feel comfortable with the return, the income that they're going to be paying? So one of the things that I'm concerned about right now, especially with muni bonds, which are paid from basically state entities, is their ability to pay. If you take a look at the state in New Jersey, first of all, there's no sales tax, not much at all. Not many people are buying things. Not as much income tax. A lot of people aren't working. You still have the tolls. Again, there's not much toll business. There's not any gas tax. The only thing they're really making money on is alcohol and the taxes associated with that. So it's difficult for them to pay their money. But again, the income that they're going to give you is how you make your money on a bond. On the opposite side, you have stocks, and you make money in stocks 2 different ways. Number one is you make it on the income that stock generates. That's called a dividend, a qualified dividend. So for example, Verizon pays I think it's almost a 5% dividend on their stock. If you have $100 of Verizon stock, you get about $5 per year in income, which is excess profit that they give back to the shareholders. That's part of how you make money. The second way that you make money on that is on the growth of the stock. Over a period of time, stocks have a tendency to appreciate. So you're making money 2 different ways. However, stocks have a tendency to be a little bit more volatile, especially if you looked at what happened in the month of March, where literally we saw 20 to 30% declines in a 4-week period of time. That's excessive. That's worse than normal, but that's the potential that you have there. And now also one of the nice things about stocks is there's a potential for a lower tax rate if you hold those things for a period of 1 year. It's called a capital gain rate. And what that means is that the ordinary tax brackets are about twice what capital gains rates are. Capital gain rate can be either 0, 15, or the top rate is 20%. The top ordinary income rates are in the 30s. So there's a benefit of basically having money in this because it's tax efficient and there's an opportunity for greater rates of return. Now, we look at the next chart, we could see that in the fundamentals of investing, I always say to people, how much pain can you take to get to where you need to work? All right, so there's all different types of investments. And one of the most common questions people always ask me is that, can I lose money on this? And I want you to write this down. You can lose money on anything if you put your mind to it, all right? So for example, if I take a low risk investment, I'm gonna take my money, I'm gonna stick it into a bank account. And right now, maybe a bank account, if it's a good bank account, is paying me 1/4 of a point. Let's just give it 0.5%, okay? Jeanne mentioned before, inflation is basically around 2%. If I put that money in a bank account where I have a guaranteed rate of return of 0.5 percentage point, I am also guaranteed to lose 1.5% on an annual basis in terms of my true spending money. I also have a loss due to taxes. So when I'm looking at risk, there's a variety of different ways that you could lose money. You need to outpace inflation just to be able to break even. And inflation generally is anywhere from 3 to 4%, all right? Then you have medium investments, and medium investments are usually a combination of stocks and bonds. Usually what I say is a moderate portfolio is probably about 60% stock and about 40% bonds. Now, again, over there, you're taking on less growth in an up market, but basically what it means is when the market comes down, you're going to take less of a hit on the way down. And then there's high risk, which are basically usually 100% stocks or 80% stock portfolios. It comes down to how comfortable and how consistent you can be in your approach. I don't mind if somebody's an aggressive investor, as long as they remain a consistently aggressive investor and don't get in and out and get in and out. I think if you remain consistent over a period of time, you should do fine in terms of your returns. Jeanne, why don't you talk a little bit about the buckets of money and how we use this in our approach towards managing money?
Absolutely. And once you understand your risk tolerance, you need to determine your investment strategy. You're going to have short, medium, and long-term needs for your money. And each of these should have a different investment strategy. We look at the short term. This is 5 years or less. The purpose of this money is really kind of for your day-to-day, kind of your expenses, your living expenses, car payments, your mortgage, etc. This is not money that you should be giving to us. This is to invest. This is money that should be liquid. And liquid is another way of saying that it can easily be converted into cash. This money should be in a savings account at your bank or a money market account. Your investments may only earn just a little bit, but you'll have that money available to you when you need it. Now, on the medium term, we're looking 5 to 10 years out here. We're looking at paying for college tuition, maybe children's wedding, or a down payment on a home. Here, we should be looking at a more moderate investment strategy. And Jerry mentioned that a minute ago. Maybe a 60% stock, 40% bonds in the portfolio. The stock portion is designed to grow and outpace inflation, and the bond portion is there to provide some stability. Now, if we look even longer term out, our long term would be 10 plus years out. Here we're looking at investing for retirement, maybe long-term care, that dream vacation that you've always wanted to have. This is where we can get more aggressive. We think about an 80% stock portfolio. That's going to give you more growth potential than a moderate strategy, but it also is going to have higher risk associated with it. But because it's long-term, we're going to have more time for you to recover from any losses. Now, Jerry is going to next talk about volatility. Jerry?
I live for it. So the reality of the market is it goes up and down over a period of time. It goes up. One of the things I always say is I'm not really a card player. I don't bet on horses. I go to Vegas and I say I'm going to spend $50 here and then I'm going to leave. I'm not a gambler. But if you ever bet against me, I guarantee one thing is that you're going to lose. And the reason why you're going to lose is I'm never going to be stupid enough to take a bet that I have any chance of losing. I still have my kindergarten money, just as a point of reference. So when I'm looking at this is really taking a look at the history of the stock market over, we have about an 80-year period of time, 72 year, about almost 100-year period of time, rather 90 years. Now, when I'm looking at some of these declines in the market, while when you're involved in those period of times, and even as recent as most as 2008, one of the things that everybody says is these are awful times to be in the stock market. And my point would be is that I wish I had invested more aggressively over that period of time. I wish that I was systematically investing more money during that period of time. Because if I liked the stock the year before when it was up 15, 20%, I should have loved it when it was on sale for 30% or 40% off its normal price. Over a period of time, it goes up. Now, one of the things I also want to point to is this thing on the side. If you're looking at the stock market in 1-year returns, 73% of the time, the stock market has a positive rate of return. That's why I like betting in the stock market. I will win 73% of the time. Now, if I were to go to Vegas and use these odds and say, if I played blackjack, I would win 3 out of every 4 hands. I would have the same bet over and over and over. But on that 4th bet that I lose to the house, I lose 100% of my investment dollars. The beautiful thing about investing in the stock market is that that 4th bet, when the market is down, I'm actually getting the best rate of return that I could ever have. If I could go back to 2008 and invest $10,000 back then, my return would have been off the wall because I would have recovered all of that and I would have had growth for a longer period of time. Now, the next thing I want to do is I want to take a look at not at 1-year returns, but if we were to take a look at this in 5-year increments. At 5-year increments, my odds of success now are 87%. They went from 3 out of 4 to almost 90% if I'm looking at the world in 5-year increments. Really recent times, in over a 5-year period of time, we have a little bit back in 2008 and a little bit back in 2000. But again, my point would have been is if I had remained consistent in my investment approach during that, I would have had the highest rate of return during that period of time. Now, again, those are good bets, but this is the bet I'm going to take. This is the next one. I'm going to take a look at the stock market over a 15-year period of time. And I'm going to bet you 15 years from now, the stock market's going to be higher than where it is right now. Does anybody want to bet me? The odds are 99% in my favor. Those are the types of things that I'm investing in. So one of the things I'm always going to say to people when we talk about money and they want to give me money to invest, I always say, when do you need it back? Do you need it back within 5 years? If you need it back within 5 years, you're not giving it to me. You're sticking it in a bank account. If you're buying a home in the next couple of years, you're not giving me this money. I'm not going to try to double this thing for you. That's not how it works. I want to say, if we're investing it for a 5-year period of time, I'm going to do it a certain, for 5 years or more, I'm going to invest in a certain way. 10 years or more, a certain way. 15 years or more, I'm going to be a little bit more aggressive because the odds are 99% in my favor that I'm going to have an opportunity to have success over that period of time. Now, again, when you look at the short term, you see a lot of volatility. It looks like a heart monitor. When you trend it out, you see that it's kind of going up on a pretty systematic basis. It got bubbles and bumps and things like that. That's life, okay? However, if we remain consistent over a period of time, this is terrific. So one of the things that I think I would be doing for many of you on here is that if you have children, I would say, let's take a look and see what we could do to get them invested at this young age. One of the questions that people always have when they come into my office is, can you make me a millionaire? And I can make anybody a millionaire. It's not that hard. You need to invest on a systematic basis, and you need to give me enough period of time to be able to grow this money. And if you give me somebody in their teens or in their 20s or early 30s, I have a much greater success with them than having somebody who comes into my office saying, listen, I want to retire in 10 years. I haven't started yet. What can you do for me? So again, I think the key is that knowing that over a 15-year period of time, your odds of winning are 99% if you remain consistent and you invest over that period of time. So let's make sure that we take that into consideration. Now, Jeannie, why don't you talk a little bit more about some of the fundamentals?
Absolutely. So we're going to talk about 3 strategies to look into today. The first is reviewing your time horizon and your risk tolerance. Second, through balancing, and the third, tax diversification. So I'll start talking about looking at your time horizon and risk tolerance. It's really important to review these on a regular basis. We want you to do this at least annually. You'll also want to do this if you've had any major life changes. So for example, if you have a new job or you're retiring, if there have been any like changes in your family status, you got married or divorced, maybe you had kids, and then also if your health changes. It's really important to kind of look at these because these will all impact your risk tolerance in your time horizon potentially. And you want to do these on that regular basis, at least once a year, to make sure that you're on target. You know, and as clients at JFL, we do this with you every time we sit down. We ask you what's new and different going on in your life. We kind of help understand where you are, and if anything has changed, you know, we continue to do this on a regular basis. Now, Jerry's going to talk a little bit more about rebalancing. Jerry?
All right, so I'm going to kind of walk you through one of the things that we do on a systematic basis with our clients and why we do it. You know, a lot of what we do looks very basic, but below the surface, there's a lot of moving parts that happen. So part of what we do every year is we evaluate the portfolios, all the individual holdings, how's the expense ratio, how's the manager tenure, how's the performance versus their peer group, and we design models around that. Now, a 60% model that we have is considered moderate. Many people that we have are in a very similar investment style. So if you were in a 60% stock portfolio in the beginning of 2019, which is moderate, we had an amazing year in 2019 where most of the stock indexes were up between 20 and 30% above what you started the year at. Well, that would mean that you're no longer 60%. It's probably that you're in a range of 70 to 75% stock, which means now you're a lot more aggressive than you needed to be. Part of what we did in January is, again, through our process, we went back and we rebalanced that portfolio, which is really just bringing it from the 70% stock that it was back down to the 60%, bringing it back down to the original allocation, take some of the chips off the table and putting it into some areas. So that's the basic investment philosophy. Sell high, buy low, and rebalancing does that. Now, again, what we did we had this year, and in March of this year, the stocks fell off a cliff, dropping 20 to 30% in a quarter. What we did at that time is we actually rebalanced again, which is more than what we normally did. At that time, we moved monies from bonds back into stocks. Okay, so in January, we sold out of stocks that had gains, so we sold high, and we bought into bonds that were low. In March of this year, we bought into stocks that were selling at a discount, and we sold out of bonds at some of the premiums. So that's something that we do. Now, one of the things that's available if you're investing in a 401k plan is there something that allows you to do, again, one of two things. You could either auto rebalance, where you set up in advance, let's say with Fidelity, that you can rebalance quarterly, semi-annually, or annually, where it goes in and automatically brings in your mix to the 60% or 80% or whatever you were. I would highly recommend that you do that for one specific reason. Is at anybody at the end of 2019 that I talked to that said, you know what, we should probably sell out of some of these winners. The overall response is, why will we sell out of winners? They just made us a boatload of money. They're going to continue to do this. And my response is, we were in the right place at the right time. Let's take the emotion out of it. Let's put this thing on autopilot. If you have to rebalance manually, it becomes an emotional decision. And I am not a fan of making emotional decisions with money. Any emotional decision I've ever made with money, I've been trying to fix up for 5 years after that because of all the repercussions. So again, if you set it up automatically through the rebalancing program there, that's perfect. The other thing that you could do is you could go into target date funds, and target date funds will automatically do that for you. So if I'm planning on retiring in 2040, I choose a 2040 fund. Each year as I get closer and closer to retirement, it gets more and more conservative. And then what happens is it'll rebalance automatically. But I would just say, set up a program either automatically or through the investments that you have that will rebalance it and continue to bring down these stock allocations over a period of time, or you'll find that you'll be a little bit more aggressive than you really want to be because your stocks are going to go higher. Now, speaking of balance, one of the things that is my biggest concern right now is I go home and I watch TV and I see everybody talking about, we need money, we're giving money away, we're giving more money to all these people, businesses, self-employed people, and everybody's getting money right now. Who's going to pay it? All right? Who's going to pay it back? Now, you ever go to a restaurant, and this is probably when you're in your 20s and everybody's having drinks and having a good time, and all of a sudden you turn around, nobody's there, and the bartender comes over and gives you the tab. That's what's happening right now. We're developing this bar tab that's getting bigger and bigger and bigger. Can we put on the next slide here? And my concern is that somebody's got to pay this tab. And it's very reasonable that, especially if you're going to be around for 20 or 30 years, or for your kids that may be around for another 50, 60 years, that they're going to get stuck paying the tab. So when I'm looking at a good retirement plan or a good investment plan, I'm taking a look at tax balance. And one of the first things I want to do is I want to have money that comes income tax free. One of the ways that I could do that is with a Roth IRA or a Roth 401k contribution. I could also get money tax free out of a bank account. So if I put in $10,000 and I take out $10,000, that comes to me tax free. The sale of a primary residence, I could get as much as $500,000 out tax free. Okay, so having that is bucket one. Bucket two is capital gains money. That's money that's been in the stock market for at least a year and will get taxed at either 0, 15%, or 20%, about half of what your normal rates are. So again, I have my tax-free, I have my capital gains. Now, the last money is ordinary income, all right? And ordinary income is when I defer money from my 401k plan and into my 401k plan, and I'm using a traditional contribution, which is a pre-tax contribution. I defer the money in there. When it comes out in retirement, it's taxable income, all right? The benefit of that is that if I'm on a high tax bracket today, I'm in a 30-something% tax bracket, I defer. Reasonably in retirement, I'll be in a lower tax bracket. So I get the benefit of deferring in a higher tax bracket and pulling it out lower. If I have all three buckets of money like this and I'm retired and they start saying, you know what, we have a lot of debt out here, we got to start figuring out a way to pay this thing off, I could choose money from different buckets to be able to balance out my income in retirement. If all my money is coming to me pre-tax and they raise the rates, I have one of two options. I take out the same amount of money, I pay more income tax, which means my quality of life is now worse, or I take out more income to have the same level of income after tax, and that puts me at jeopardy of running out of money. If I have all three of these buckets, I could take a combination of all three of these tax benefits to control my taxable income in retirement. And I think, again, just looking at the amount of debt we have out there, this is something that I think is incredibly important. The younger you are, the more important I think it is. So each year with my kids, if they work, I set them up on a Roth IRA because for two reasons. Number one is they're in the lowest tax bracket of their life. They're in a 0% tax bracket. I want to take advantage of that. I don't want to defer any of that income. And it's also the most powerful money that they're ever going to invest. My oldest son I have one that's 20, one that's 18, one that's 16. So that's the longest amount of time they're going to have in their life in an investment cycle. So I want to capture that money. I want it to be tax-free. And in the future, they're going to thank me. Not now. They don't have a clue what I'm talking about right now, but at some point in the future, they're going to be happy about it. So Jeanne, you want to talk a little bit about some of the 401k strategies?
Absolutely. There we go. So one great tool, if you have access to it and you're eligible for it, is the company 401k. So first look and see if your plan has that target date fund. Jerry mentioned this a moment ago, and these are the funds that automatically rebalance as you get closer to retirement. All you have to do is just pick the year that you want to retire, and you're all set. And if you can afford to, you should be looking at contributing and putting in at least what your employer matches. Now, many companies have a match, and they kind of work this way. Let's assume, for example, that you make $100,000, and your company is going to match 100% up to 3% of your salary. This means that if you put in $3,000, that the company is going to match that contribution with another $3,000. You've put in 3, you've doubled your investment. That's free money. Should really take advantage of that one. When the market dropped this spring, many investors were fearful and they wanted to stop investing. We believe it's important to continue investing even during the downturns, and if you're able to, maybe increase that contribution into your 401k. And Jerry mentioned before, the money that you invest when the market's on that downturn, that's some of the most powerful money that you can be investing because you're essentially buying stocks on sale at that point in time. Now, if you're not eligible for a 401k, look into investing into an IRA. That's an individual retirement account. Or if you or your spouse aren't working, that non-working spouse can still contribute, and they can contribute to something called a spousal IRA. One of the questions we get asked all the time is, how much do I need to save for retirement? The simple answer is it depends. It depends on your spending, it depends if you have a pension, where you're gonna live, etc. Now I'm gonna give you a 5-star tip right now, and I want you to write this one down. I want you to write down the 10 times rule. And the 10 times rule is really a good rule of thumb that at age 67, you should have 10 times your salary saved. For example, if you make $50,000, at age 67, you should have $500,000 saved. At age 60, 400,000, age 50, 300,000. These numbers, they can really gauge to help if you're on track or if you need to make some changes and adjust your savings. And what if it's lower? You know, it's not all doom and gloom. You do still have options. You know, you have the option at this point, you can start saving more. You can decide to spend less. You can maybe plan to work a little longer or change what your expectations are for retirement. And another question we get asked a lot is why there seems to be a disconnect between the stock market results and what's going on in the economy. This is particularly apparent in today's environment. You know, we've seen record unemployment over the last 10 weeks when everyone's been under quarantine. But the S&P 500, you know, that's up 200 points. That's 200 points higher than where it was in January of 2019. So why do these two not seem to reflect each other? So I'm going to tell you another thing to write down. I want you to write down walk the dog. Walk the dog. It's a simple analogy. The economy is you with the leash walking your dog down the sidewalk. The dog is the stock market. Now you may have, you know, like a lot of other people, adopted a new dog or a puppy during this quarantine, and you imagine trying to walk that new dog down the street. You know, you're walking that straight line down the street, but your puppy is kind of all over the place, walking. Oh, there's a squirrel. Oh, something smells good over here. Oh, I think I'm gonna stop here. You know, you're both moving in that same general direction, but the dog's all over the place. So the stock market and the economy work in the same way. They're going in that same general direction. They're not in sync, but overall, during the long term, they end up about the same. So, you know, on a final note, we wouldn't be JFL without a little bit of humor. Gretchen?
So here's our weekly dose, or I guess a couple weeks it's been since our last one, but I thought this one was pretty funny. So we've now finished up our formal portion of the presentation on fundamentals of investing. This is the opportunity, if anybody has questions that they'd like to post, we're happy to address them to the group. And we've actually gotten 2 in that I can ask Jeannie and Jerry right now, but feel free to list any more that you may have gotten. So this one asks, with everything that's happening, should I still be investing?
I'll take this. Yes. Just kidding. Sorry, I've been locked up for a long period of time. Yeah, again, just getting back to what I was saying before, I'm not worried about what's happening in this moment in time. Gretzky was a famous hockey player, and what he used to say is the reason why he was good is he wasn't focused on where the puck was, he was focused on where the puck is going. All right, I know the market's going up higher, and the reason why I know is that it happens 99% of the time over a 15-year period of time. You know, to stop investing when you could buy everything at a discount would just be kind of insane. You know, I do think that when we're investing, what we try to do, and Jeannie showed it before with the buckets, is we need to have some stuff conservative. If you're retired right now, I want to have enough money to take care of you for quite a while before I ever have to sell stock at a discount. But I also have to assume if you're retiring today, reasonably, I've got to assume that you're going to live like another 30 years. So part of what we're doing is we're not just thinking about like what's happening at this specific moment in time, but where are we going to be 30 years from now? And I feel very comfortable that 30 years from now, the stock market is going to be substantially higher than where it is right now. And any investing that we do over this period of time, we are going to look back at this and saying, thank God I took advantage of this dip in market. So again, I'm not changing my long-term strategy because of a short-term situation, and you shouldn't either.
Okay. Somebody else wrote in, during the presentation you mentioned a spousal IRA. Can one of you provide a little bit more information about what that is?
I can do that. So a spousal IRA is an individual retirement account for a non-working spouse. And an IRA is something that you set up on your own. You're able to put in money tax deferred, and you have the tax deferred savings. So you put in pre-tax money and it grows tax deferred for you. You're able to put in $6,000 a year, or if you're 50 years or older, you can put in an additional bonus $1,000. So total potential of $7,000. Now, you can only participate or contribute to an IRA if you have earned income. So you need to have salary, you need to be making money. And if you're not working, the government gives the option of a spousal IRA, where the non-working spouse is still able to contribute to an IRA, even if they personally are not earning the income. It's a great thing to take advantage of.
Great. So I want to be cognizant of time today and thank everybody for joining us. I think that's going to wrap up the last of our questions and the presentation. Jerry, did you have any last comments you wanted to add before we wrap this up?
Yeah, I really need a haircut. I have to use so much stuff to get my hair from going out this big. It's been an interesting couple of weeks and months rather. And you look at this stuff, and one of the things everybody keeps on saying, when's it going to end? With every one of these things that happen, whether it's 9/11, whether it's 2000, the world evolves. And over a period of time, it creates a new normal. I don't think things are going to be much different in the future. I think they'll be different to a certain extent. When we're taking a look at everything that's happening out right now, everybody, the common line I hear is this is different. It's not different. It's the same thing as a 9/11 or a 2000 in terms of what the impact on the market is. The market is going to adjust. Businesses are going to figure out new way to do business, and then we're going to kind of move forward. And in a few years from now, we're not going to even remember this, or we won't remember it with the intensity that we're remembering it right now. I think as we go through this, just remember that we're a resource for you. If you have questions on anything, please feel free to reach out and give us a call, or concerns on anything. With the presentation today, I would just say too, is if you have kids and you want to start them getting off investing young, send this to them, have them watch it for a few minutes. And if they have any questions, we're available to speak with them on an individual basis. We're probably going to start doing some presentations really focused more towards your kids as well too, that really bring this out a little bit more. What can I be doing in my 20s? If I'm getting married, what should I be doing? Some basic estate planning and so forth. So again, I just want to thank everybody for their time. Stay safe. If there's anything you need from us, please let us know. And it is a pleasure to work with you. Thank you very much.
Thanks, Jerry. Thanks, Jeannie. And thank you everybody who attended today. If any of your questions weren't answered, we'll definitely follow up with you individually. And as Jerry mentioned, if you have any questions, please call our office. Hope everyone stays safe and has a wonderful holiday weekend.